Some investors fear a bubble could be brewing in the corporate debt market. In his latest piece, The Big Dangerous Bubble in Corporate Debt, former investment banker and author Bill Cohan writes that the debt market could even lead to the next economic crisis. And Bill joins us now to discuss. Very good afternoon to you, Bill.
Hey, Wilfred, how are you?
Very well indeed, thank you. So your point on this is that there's been a huge amount of issuance of corporate debt, and when rates rise, there could be some frightening wake-up calls for individuals.
Right. I think it's a combination of an unbelievable amount of new issuance because interest rates have been so low for so long, and combined with the Fed's 8-year quantitative easing program, where they essentially bought back as much debt as they could in the marketplace, increasing their balance sheet from like $900 billion to $4.5 trillion, and how that unwinds. And I think that investors, as I'm sure you've talked about many times on your show, have been desperate for yield. And so as a result of interest rates being kept long for so long and investors being desperate for yield, they start bidding up the price of bonds that look like they're yielding, a greater amount over treasuries. And as a result of that bidding process, the yield, of course, goes down. And so as a result, risk has been mispriced for a very long time in the market. It's starting to be better priced now, by the way. I want to make that clear. This is sort of maybe an 8-year period before the last year or so. And so there's a lot of money, trillions of dollars, that has been invested in the bond market. And I think that the risks have been mispriced. And that is going to come home to roost at some point as corporate defaults go up and as interest rates continue to rise.
Bill, I have a flip side to this, which maybe some of the buyers of these bonds may have a bit of a wake-up call to come. But if you compare the US today, perhaps, versus some companies still in Europe, they've sorted out their finances by refinancing at lower rates on longer-term issuance. So surely they are in a safer place, even if some of the buyers of that debt may be due a wake-up call. So is there an offset there that corporate America is in a stronger position or not?
Yes, I think both not only U.S. banks, but U.S. corporations are in a better position. For issuers, this has been basically fabulous unless the credit markets close completely and they can't refinance all their debt. Let's take AT&T. Post-Time Warner has like $180 billion of debt on their balance sheet. If they can't refinance that over time, they're going to be a problem as an issuer and as a borrower. The problem is among the investors. The problem is among the people who buy this corporate debt, who've been hungry for yield, who've been bidding up the price of bonds to try to capture that yield, and I think they've been overpaying. And we'll see. I think there's a huge risk as a result of that, and people don't realize it, and frankly, until it's too late, until the markets start contracting, until defaults go up, until they can't refinance, until they can't get paid back, and then it's a sorry tale.
Yeah, Bill, it's Sarah. The IMF has been warning about this for a little while now, and in fact, those warnings have gotten louder recently. The amount of corporate debt. It's not just in the U.S., it's elsewhere as well. And it's not a problem, as you say, until it is. I guess I'm just wondering what turns the tide, and is it as big of a problem in this country as it is in places like China, where it's really exaggerated?
Well, look, it's definitely a problem in Europe, where quantitative easing has been copied, because I think a lot of central bankers around the world thought this worked out very well here. Sarah, as you know, nobody rings a bell at the top of the market and says, that's it, it's all downhill from here. It's been fun, thanks for playing. It happens over time. It happens suddenly. I remember, frankly, when I was a banker, and this goes back a way, but, United Airlines was trying to take itself private, and it looked to Citigroup, who had issued a highly confident letter that they could provide the financing for the management buyout of Citigroup. This took place in 1989. And then when that didn't happen, the market closed, the credit markets closed for close to 4 years, and there was a credit freeze, and that, we were in a serious recession at that time as a result. So, it seems like a great party until it stops. I'm thinking, and I'm not alone in this, there are many bond investors and big bond funds that feel the same way, that this party has gone on for a very long time, and it's feeling very toppy, and people have bid up the price of bonds and their yields have been lowered, where they're not getting properly compensated for the risks that they're taking.
Bill, are there other areas out there, other sort of asset classes or markets that you think are in a similar position where the risk has been mispriced, whether that's the private markets, venture capital, private equity perhaps?
Well, I think a lot of real estate has been mispriced. Cap rates have been too low for too long. The art market, I think, is wildly overpriced. But, I think the big problem, it's a $41 trillion corporate bond market. It dwarfs by like 50% the size of the stock market. And I think people forget that there's a lot of risk in the bond market. And when the credit markets close up, that's where people can't get access to the capital that they need to grow their businesses or hire new people or build new plant and equipment. Then everything seizes up and we head into recession land. And that can happen before you know it.